Hello all, I'm Geeta Chainani, Associate Director in BFSI Vertical at CareEdge, and I'm going to speak about whether the proposal to introduce a new high-risk category shall bring back credit risk appetite in debt mutual funds. The Securities and Exchange Board of India has recently put forward a proposal to introduce a new category of high-risk debt mutual funds. This proposal, still in its early stages and under discussion with various stakeholders, anticipates that these high-risk mutual funds will be subject to some relaxations in sectoral and exposure norms. They will also be permitted to employ high-risk investment strategies which will enable them to generate relatively high returns. Designed to appeal to retail investors with greater risk appetite and a more sophisticated understanding of risk factors, this new category may feature elevated minimum investment thresholds. While the minimum investment threshold in various debt mutual funds currently ranges from Rs 100 to Rs 5,000, this threshold is expected to be higher for proposed category but still lower than that for portfolio management services and alternative investment funds, which stand at Rs 50 lakhs and Rs 1 crore respectively. Given the inherent risks associated with this category, Sebi might allow closed or gated fund structures, which would include periodic redemption cycles. This proposal emerges against the backdrop of assets under management in debt mutual funds experiencing stagnation and significant outflows in the last 2 to 3 years. Debt mutual funds have seen outflows in 12 out of the last 18 quarters, spanning from Q1 of FY20 to Q2 of FY24. During this period, outflows from debt mutual funds amounted to approximately 1.3 lakh crore. This has led to consistent decline in the proportion of debt mutual fund AUM as a percentage of the total mutual fund industry AUM, dropping from 53% in March 2020 to 30% in September 2023. While some proportion of the declining mix can be attributed to rising valuations of equity mutual funds, absolute AUMs of debt mutual funds have been range-bound. The growing popularity of equity funds, rising trend of bond yields, as well as mutual returns have together contributed to outflows. Since March 2019, debt mutual funds have broadly delivered 100 to 200 basis higher pre-tax returns across tenures compared to fixed deposits. One of the reasons for this is since debt mutual funds are actively managed. This excludes annualized returns for FY21 and 22 since returns during this period were impacted by liquidity disruptions triggered by COVID-19. However, the AUMs of debt mutual funds have been range-bound over the last several quarters. Post-March 2023, the amendment in taxation of debt mutual funds too has taken away some sheen of the same as an asset class. The AUM of open-ended debt mutual funds stood at roughly Rs 13 lakh crore as compared to outstanding term deposits base of banking sector at 1.15 lakh crore as on September 30, 2023. Thereby showcasing the scope of growth of debt mutual fund industry. On the credit risk fund, the risk of sentiment has led to higher mix of safer securities within various categories of debt mutual funds. The trend towards prioritizing safer and more liquid securities in the mutual fund industry had already begun due to the credit crisis. This shift gained further momentum following the winding up of few debt mutual fund schemes and the implementation of significant regulatory changes which have played a crucial role in shaping the investment strategies within the sector. An analysis of rating mix of securities in credit risk and medium duration funds since June 2020 to September 2023 shows dip in the proportion of securities in A and below rated categories, largely contributed by declining risk-reward trade-offs in corporate and BFSI securities, as well as increased risk aversion. To summarize, CareRating opines that the recent proposal by Sebi to introduce a new category shall be beneficial for the entire mutual fund industry. This perspective is particularly positive for debt mutual funds, which have encountered several challenges in the recent years. These challenges include the withdrawal of indexation benefits, credit crisis, liquidity disruptions triggered by COVID-19, regulatory changes, and a cycle of rising interest rates. The removal of indexation benefits has created a more level playing field with other investment products in terms of returns. However, debt mutual funds remain susceptible to interest rate cycles, which can adversely impact returns. In this backdrop, Sebi's proposal to establish a new type of high risk mutual fund category is expected to provide a boost to the industry. This move is particularly timely given the range bound AUMs observed over the last several quarters and is likely to provide the much required fillip for growth. Thank you for listening to this podcast and do stay tuned for further podcasts from CareEdge Ratings.